Today's question is from Monica. Why can't I use cash for closing? Isn't cash the best way to pay for anything? That is a tough one. If you owe me $100 and you're going to pay me today, I would much rather you gave me $100 cash than any other form of payment. Check, credit card, PayPal, whatever. I want $100 cash. I think most people probably feel the same way. But the mortgage business is a little bit different. Think of it this way. Whenever we put a loan together, the lender is taking on a risk. They're taking on a risk as to whether you're paying. And that risk is reflected in so many different ways, especially the interest rate. Let's say, for example, that you put 10% down on a house. Okay? So you're buying a $100,000 house, you're putting 10% down, you're putting 10 grand down. That 90% that the lender is lending you is part of their risk, okay? That if they're only lending you 80%, that's less risk than lending you 90% or lending you 100%. So the higher the percentage of that property, of that purchase price that they're lending you, the higher the risk is of the loan. So they want to know that it is all that's being borrowed for this house. They need to make sure that the 10% you're bringing down and any closing costs, that was all your money. Absolutely all your money. Well, here's the thing. If you write a check, we can see where the check comes from. We have the funds sourced and seasoned in your bank account for 2 months. It's traceable is what I'm trying to say. We can tell it was your money. If you just bring cash to closing, we don't know where that came from. And unfortunately, in the mortgage business, you're guilty until proven innocent. That money could have justifiably been yours, been sitting in a safe in your house for 10 years, but we have no proof of that. And if we can't prove that it's clean, then we automatically think it's dirty. I hate to say it like that, but yeah, we have no proof that that money hasn't been borrowed from someone. Because let's say you literally did borrow $5,000 to buy this house in addition to the $90,000 the lender gave you. Well, this is now a loan that there's 95% combined loan to value. 95% is being borrowed to buy this house, where we graded it as a 90% loan to value. And also, if you're borrowing money from someone else, you have to pay them back at some point. That's going to affect your ability to repay. Your debt ratio is off. Your ability to repay is not been calculated correctly. So yeah, we need to have the funds come from a bank account, and those funds have to have been in there for at least 2 months. Before that, we don't look back that far. All right, I hope I answered your question. I know that's a tough one, and I know it kind of doesn't make sense, but that is the mortgage business. It doesn't always make sense. Thanks. Thanks for watching. Please subscribe. And if you have any questions you'd like me to address in a future video, please leave it in the comments below. If you're in Florida and interested in a mortgage, check out the description for my links. Thanks again.